Hey, welcome to the Guaranteed Retirement Guys show. So today I'm going to talk to you about whole life insurance. So what is whole life insurance? How is it used? Why do people buy it? Is it something that you should use for yourself versus maybe term or an index universal life policy? Really just depends on maybe your risk tolerance, your goals, what you're looking for. And traditionally, people have always looked to whole life as far as giving them a guaranteed death benefit for the rest of their life. They want to make sure that that lasts till age 100. And if they don't die at age 100, then they get all of that back. They get the entire, the whole death benefit will be paid to you. So that's why it's called whole life. It's for your whole life. And it's typically not for, I would say, they do grow and they do compound depending on what dividend is paid. But they usually will not grow or give you the type of wealth that you're looking for. Have you put your money into an index universal life policy, just because those policies are tied to indexes, and those indexes typically will earn a lot more. But let's talk about a whole life, because they do have place for some of us that want that guarantee, and we want to make sure that no matter what happens, that death benefit's going to be there, that cash value is going to be there. We don't want any risk. We don't want any what ifs. We want to absolutely know what it's going to be no matter what. And so if that's you, then you're going to love this, because this is one of the best whole life policies that you can get. So I'm going to share my screen. And notice what I did, and I'm going to do a few different illustrations I'm going to show here, because everyone has different goals. And so here's what I did for this. This whole life policy was accumulation focused. Okay, so I didn't put a death benefit of $100,000, and I just want to make sure it's $100,000 by the time that I pass away. But instead, I wanted something that would accumulate a lot more. And so here's what this looks like. You'll notice that the premium outlay per year is $6,564. So roughly, you're paying $500 a month into this. And you'll notice that I'm paying $500 a month into this until I reach 65. And I'm basing this off of my age at 42. At age 65, it's accumulated enough and the dividends are earning enough where I don't have to put as much into this if I don't want to. And so at that point, my premiums are reduced to around $1,600, $1,627 to be exact. And I pay that all the way until age 100. And at that point, you'll notice that the guaranteed death benefit and cash value are both worth $344,181. So either I die, my beneficiaries will get $344,000 tax-free, or if I want to surrender, I can take $344,000 out that way. So you'll notice this column right here. This is the column. I'll just go all the way to the top here. You see the net cash value increase? You notice this is what goes up every year. That's the net cash value increase after you pay your premiums, the cost of insurance, and the dividends that are being paid. Okay, so you'll notice that goes up over time, which of course affects this column right here, the net cash value. And you notice that of course, will increase accordingly. Now, you'll notice here, this column is not rising as fast, the annual dividend. And this, again, if people are looking for maximum growth and they want tax-free retirement income, I highly recommend looking at an index universal life policy versus a whole life, because you're going to earn a whole lot more than this annual dividend. So you can see this annual dividend, though, does compound. And over time, by the time you reach your 65, it's now at $350 a year in an annual dividend. And then you'll notice by the time you reach your late 80s, now it's paying annual dividends of almost $2,000 a year. So that is, that's nice. That's going up. And then, of course, once you reach your 90s, the cost of insurance actually goes down, which helps us accelerate even faster as far as the death benefit and the cash value. You'll notice during this time between ages, whatever age you are and age 100, you'll see the cash value column here. It never equals the death benefit. And the reason for that is because you have to have some type of corridor, is what insurance companies call it. It's a cushion. It's a cushion of, you have, 100,000 of cash here. It has to be some type of insurance, pure insurance, which means it's got to be more than what your cash value is. You got to have some form of pure insurance on top of that. And so that's why you'll always see the death benefit higher than the net cash value. Because if you pass away at, let's say 55, the cash value might be $93,000, but the death benefit is guaranteed to be $459,730. But you'll notice over time, the closer you get age 100, that cash value will close the gap. And eventually, at age 99, age 100, at the end of that age of 99, turning 100, it's worth exactly what the death benefit is. And that's just because at that point, if you haven't died at that point, they just pay it out to you. Okay. So that's how whole life policies work. They are for guarantees. You want a guaranteed annual dividend and you want to know exactly what it is. This is perfect. If you want to know exactly what your death benefit is going to be at any given age, you're going to know exactly what it is. If you want to take loans against the cash value, you can do so. You just have to make sure if you are taking a loan, make sure the interest rate charged on that loan is lower than the cost of the dividends combined with whatever premium that you're putting in. Otherwise, your cash value will start going down. And so if it goes down too far, you can lapse the policy. So that's always something to think about. That's why you got to structure these right. Okay, so this is accumulation focused. Let's go back and just kind of look at a different scenario here. Maybe I want to just do protection focus. Okay, so I'll do just in total face amount $100,000. And then what I'm going to do is I'm just going to go right into here and say, all right, $100,000, protection focused. But since I want to be protected, it's going to automatically, if you notice, it actually puts a death benefit starting out at $300,000. And I can play with these numbers, but this gives you an idea. Contract premium guaranteed, you're looking at $1,585. Okay, that's what you got to put in every single year. You see the annual dividends, pretty small. It's like $6 or $7 a year. And of course, the net cash value goes up. And you'll notice that this one is a little bit different. Okay, it has $300,000 for the time you need it. And then once you get to a certain age, like at this point, it has age 61, then it drops it down to 100,000. So it allows your cash accumulation to continue on at a little bit faster rate because now your cost of insurance is lower. But you don't need as much insurance. You don't need 300,000 anymore. So people will do these type of policies if they need insurance now. They need more now because maybe you've got dependents. And then later on, you don't need as much, but you still want it guaranteed for the rest of your life. That is an option that you could do. And you'll notice that the annual payment drops to around $1,197, so roughly $1,200 a year. So it drops a little bit, but you got to make sure you keep paying it. That's the thing with the whole life policies is you got to keep paying it. Whatever that contract premium is, you better pay it or you could lapse the policy. With index universal life policies, we typically will push a bunch of money into it in the beginning. And then there's enough interest being earned where it covers the cost of insurance plus the cost of the tax-free loans that we take for retirement income. Okay, so let's see here. I'm just going to go in here one more time and just look at one more option here. Let's say I just put none and I want more than 100,000. Okay, let's say I want to guarantee 500,000. I want to make sure I have that no matter what. Okay. So I'm going to go in here and I'm going to put in cash for the dividend scale. And then I'm going to put premium mode, of course, annual. You could do this monthly, but this just kind of gives you an idea of what it looks like. Okay. So I'm going to go in here and take a look at how this works. So now, here's what it looks like. You see how the death benefit starts out at $700,000? You notice it'll drop to $500,000 at age 63. So because remember, we want at least $500,000. And you notice that will eventually bump up a little bit. By the time you reach 100 years old, it's actually $516,000. And you notice that the premium is a little bit lower too. It's like $78.80. But remember, you have to keep paying that premium. Okay, this is set up to pay the premium for life. So make sure that you're committed to that. In the beginning, of course, the premium is a little bit higher. It's at $82.68. So not too bad, almost $700 a month. But something to think about when you're planning this. And so, yeah, you've got premium outlay going in. You've got annual dividends, which start out small, around $50 a year, and then starts rising in your 70s, 80s, down $3,000, $4,000 a year in dividends. Okay, those are guaranteed, absolutely guaranteed. You keep paying that contract premium, those annual dividends are guaranteed. Net cash value increase, that's guaranteed. Okay, you can also see net cash value, that's guaranteed. And so is the death benefit. Death benefit is guaranteed to be $700,000 for the first, roughly 20 years. Okay, that's guaranteed. But then, of course, we don't need insurance usually as much after that age. And so typically people will need less. And so since we put in here, we want at least 500,000 and we want that to be guaranteed until we are 100 years old, then it bases the premium off of that. It says, okay, well, if we're going to guarantee that $500,000 to you, you need to be paying out after 62, you need to be paying out $7,880 a year for the rest of your life. Okay. That's how you guarantee that. But this is a great opportunity to lock in lower rates, because if you were to do this with a term policy at 65, it'd be way higher. So this is something, if you're thinking about doing a whole life policy, do it earlier rather than later, because you can just lock in a lower payment forever. And you know exactly what you're going to get in dividends. You know exactly what you're going to get for a death benefit and at what age, and also exactly what your cash value is going to be. So if you want a loan against your cash value at a certain age, you can do that. You know exactly what it's going to be. There are no surprises whatsoever. So versus an index universal life, you usually will have a much, much higher growth rate, but at the same time, it's not guaranteed. So we never know what the index is going to do. That's why it's called an index universal life. But for those who want a lot more growth, they go with that. They look for more growth, more tax-free income. Those are the way to go. But if you want guarantees and you want to know absolutely what you are getting, then a whole life is absolutely one of the best things that you can do. So, and again, I'm showing this as one of the best options as far as guarantees. I'm happy to go over specific numbers with you. Just schedule a call with me. You'll notice that there is a link below where you can get on my calendar, and we'll discuss whatever options you're looking for. If you're looking for just accumulation, or if you're looking for just a guaranteed death benefit that will last all the way till age 100, doesn't matter what you're looking for. I'll look at the very best policies that will fit you. I have access to all the companies, so it really doesn't matter to me what you use, but I typically will show the companies that are A-rated, that have been around the longest, and also that have a history of better growth than other companies and lower costs. So anyways, if that's something that you want me to go over with you, let me know. Some people want to do huge policies, maybe $10,000 a month, even more. I set up those as well. So if that's something you want me to look at for you, I'm happy to check out the numbers. So anyways, thanks for watching. Look forward to meeting with you, and I'll see you in the next video.